Good morning, traders. It's 8:03 a.m. Chicago time on Wednesday, the 13th of December, 2023. Thanks for joining me on this episode, number 2589. So close to 2600. Unfortunately, I think we'll miss the 2600 mark before 2023 is done, since I'll be gone for the holidays. Thanks, Vernon. Gone a little bit emoji drunk there. Appreciate it every morning. I want to remind you that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. So, first things first, diving right into the convergent trading pre-market summary sheet here. We did get the PPI release this morning, US PPI. That number came in pretty tame, came in at 0% month on month on PPI. That's the producer price index. It is the change in price for manufacturing, for inputs into manufacturing. 0% was expected at plus 0.1. Now, the prior is negative 0.4, so don't forget that we actually went up, was expected at plus 0.1, but came in at 0. And core PPI came in at 0, was 0 last time, was expected at plus 0.2. So the market got another indication that inflation is actually, relatively tame. And then what's left ahead of us is crude oil stock change, the EIA crude oil inventory at 1030, expecting a draw of 650,000 barrels. Gasoline expecting a surplus of 1.933 million. And then the big one today is the FOMC interest rate decision and the conference, as well as the dot plot and the projections, the economic projections. So remember, the market is kind of pricing in the likelihood that the Fed will have to cut rates sometime in May, June. That's changing a little bit. We'll see, but this still is a big piece. Now, it's high for longer, high interest rates for longer, and so we haven't, we have a big macro driver like we've been seeing for the last year. Yeah, for about the last year and some last year and a few months. And that's what the market's paying attention to. Other than that, UK GDP came in weaker than expected, and that's about it. Very, very quiet overnight session. The S&P is in a balanced, extremely balanced profile. So is the NASDAQ, and they're both breaking higher now. But I came in this morning and looked at the profile and thought something's wrong with my data feed. We still have the roll looming. The pace of the roll is actually is moving along very nicely. I'm going to bring that up for you. Pace of the roll. Here we go. Here's the tool. There's the pace of the roll. Let's zoom into this chart down here. This is the important one. And you can see that the pace of the roll is exactly in line with what's expected. The current roll is at 72.16%. The average roll once complete is at 78.9. So you do the math here, 72. It's about 92% done currently. So I'm expecting that by the end of today, we've had some kind of goofy rolls the last couple times. I think the roll to December and the roll to September were kind of a little bit wacky, especially the roll to December. But this roll here represents a pretty standard roll. And the expectation from that is that it is very likely that we would be done with the roll by the end of today's session, so that tomorrow, while we still have calendar spreads lingering, we'll likely still have some delta and gamma hedging into the expiration on Friday, triple witching Friday. The bulk of what's the spreads, the calendar spreads that roll positions from December to March, the new contract or the front month, are likely to be to have less of an effect. So starting tomorrow, I can lean more on delta and volume and so on. It's expected to be a more normal trade. So the S&P completely balanced, awful overnight session, terrible overnight session. 155,000 contracts traded in the overnight session, relatively light, especially for a roll. And then the inventory is 100% long. We are remaining 100% of that volume occurred above the prior close. The market's tilted to the buy side. And then unfortunately, 9 points of range, and that has expanded a few points since I got in this morning about an hour ago. The point of control shifting to above 4,700. We've regained 4,700. We've regained basically the high we had for the year, the area of the high for the year, which was in July, and that's where we are. So let's take a look at the technical side of things here. So until the PPI, this was your range right here. This was the range. That's it. You had a high of 47.05 and a low of 47.01. How devastatingly awful is that? And it has broken out to the top side. We're holding full session mid VWAP below us, full session mid VWAP overlaying the overnight point of control, so completely balanced, and we're trying to push away. So we don't want to read too much into this. Yesterday's rally, this move right here, I found to be difficult to jump on. Those of you who are part of Convergent Trading, we talked about this during yesterday's trade talk. What would have been a setup at the low against the 66 to 68 and 70 area. Remember yesterday we're looking for 70 as the LIS or the over underline, and it pushed right through. And when it turned around, it didn't really create an actual setup to get on this push higher. And then it ended up finishing pretty strong on the session. So a rally into the close. We've been seeing that lately, a rally into the afternoon. And then what that did is gave us this profile here. So we ended up taking out the single prints from July. We ended up closing the gap from July, and we ended up going back to where we were expecting. If you recall, yesterday I talked about 47, what was it, 47.03, something like that, 47.03. We pushed towards that. So that's what we got. Yesterday's profile tested, pulled back, and tested the prior point of control, almost tested the prior high, and then rallied right off of that and finished pretty strong. So again, we keep trading in what looks like a double distribution or a triple distribution, just like the day before. We had this and this, we had this and this, we had this and this, and in this one we had multiple of these kind of. So you can see that there's a lot of price discovery. There's a kind of a big steady push from the buyers into the close, into these sessions. I mean, here we are recovering up to the upper quartile of the range again and again and again, closing at the high. Very strong close yesterday. Incomplete auction, so we expect it to push higher overnight, and it's done that. So let's pull back to where we are. Let's look at where we are. This is where we are. This is what we're trading. And if you recall back then, we had this we had this balance zone right in here, like this. And we are currently trading right here. So we cleaned up this naked point of control. We're pushing into the upper distribution. So what I'll do is I'll build a profile in this region. So we have a breakout day and then a reversion. So I'm going to create a profile right here at 8:30 basically and start building a profile until this day here ends. Boop. Like that. So we can see what this auction looked like when we were there last. So where we are right now is right on top of the point of control of this entire region. And we have a dividing line right here, yesterday's settlement. It's easier for me to draw it this way. So we have this divot in the profile. And so we have an upper distribution and a lower distribution with the 4697 kind of splitting the two. We're currently back in the balance from July, from late July into early August when we started to sell off. We started to sell off immediately when we turned the leaf over into August. So the question becomes this. The question becomes, is there enough, this is all built on a Fed that's raising rates, but is there enough liquidity here to continue to just push right through and take out the high of the year here? Or are we back in equilibrium and we build a few days, we balance, we trade back and forth before we have enough of a base to generate enough contracts off sides to generate that liquidity to push through the high? The expectation is it's probably going to take out the high of the year. Of course, it's come all the way back. It's been very, very strong. It's come a long ways. We're in the Santa Claus rally part of the year, so we may see the market finish the year relatively strong, and that wouldn't be surprising. And that sets us off for January of a little bit of cleanup, a little bit of volatility early in January, rebalance, and then January then starts setting the mood for the first half of the year, as it often does. I always look at January like it's the initial balance for the first half of the year. So that's what we're looking at here. We're back in this mess is where we are, and the point of control is right where we are currently, 4706. And so as we are trading in this region here, you could see why the overnight session is so tight, it's so wound up. It does not help that the FOMC is today, of course. Everybody's just going to sit and wait, and that's just the facts. There's a pretty decent-sized coil in the overnight session. It doesn't have that much volume, and then any pushes down are likely to squeeze right through into yesterday's 87 zone, this 87-90 zone on pullbacks. And then to the upside, you simply have to refer back to those old profiles and see where the edges of those profiles are. And that's how I would look to set those up. Otherwise, it's very, very difficult to read. Looking at the NQ, same story. NQ finishing close to the 16.6. So as we move back in the NQ into July, same darn thing. Well, the NQ actually is a lot stronger. Looks like we're above. I need to look at the composites. So here's the S&P pushing into this area right here. The NQ appears to have, yep, the NQ has actually cleaned that up already. So nothing holding this thing back. Crude continues to struggle to get off the bottom. I mean, crude yesterday, if you recall, I said 2 days ago, I said that the natural thing that's expected here, the next part of the auction, given where we opened 2 days ago, the expectation is it's very likely to come back and retest this 72.22 to 37 area to clean up and check this this void. And what it did is it kind of pushed a little bit. Then the next day pushed a little bit more. Only took out the prior high by 8 ticks. And then yesterday I said, well, it's opening in a drive, what looks like a drive down. It's very likely to take this low out. So what you have here is, like I drew yesterday, this expectation that it's likely to just squeeze down, continue to squeeze down, and it did that. But notice that the drop yesterday didn't really gain that much territory into the 68 handle. It did not extend that much further. So it went from 68.80 to 68.22. It's not that much. And then today it's opening and bounce. So I'm expecting crude to just bounce out and then make its way back into this gap zone right here, this most recent gap right here into the 70s. But crude is just in a holding pattern right now. That's it. What else is there? That's it. Today, take it easy, FOMC, and we're gonna have to just wait to see what how the market responds. My recommendation is not to try to jump into the news to try to read what the market does. I know it's enticing to see the movement, but we used to scalp the FOMC. Actually, the biggest trades are FOMC and non-farm payroll trades, but I would not try to do that. Wait for the press conference. Look for where the flow is coming in. In other words, the wiggle doesn't matter. The break of the wiggle is what matters. Look for the run from there, and then that's the side that I'll be looking to trade from. The expectation by the market is it's all bullish, it's all dovish. We'll see what that does. It'll continue to put pressure on crude for a bit, and then the equities continue higher. There's a lot of money sitting in those treasuries that's now going to look to seek risk. It is not a good day to stick your neck out. It just isn't. Okay? Good luck today, and I will catch you tomorrow morning. Take care.